Jeff Cohn, the investment guy. Jeff.
Yo.
You know that reference?
Bob the Builder. Can he fix it?
Come on. No, it's Bill Nye. Bill Nye, the science guy.
We weren't allowed to watch
Tell
that
m-
growing up.
That was outlawed in the Cohn
Yeah.
household?
No Bill
Well,
Nye. No
what's wrong
Mr.
with Bill Nye?
Rogers. No Nickelodeon.
That's funny. Bill Nye is a staple of my childhood. That's how I learned science.
That explains a lot. Hey, I like it. I'm okay with the Chan, dude. Keep bringing me
There
in like
you go.
that. That's cool.
I'm gonna come up with something every week, every month. But I know we start with the icebreaker. Had a fun travel horror story from over the weekend, but wanted to kick it to you if anything comes to mind in terms of travel horror stories.
Yeah, a few. So I grew up in Northwest Arkansas, and I go back twice a year usually. 'Cause I live in Columbus, Ohio, right? So it's to my house in Arkansas, it's like an 11-hour drive, and to the campground I go to for the family reunion in Oklahoma every year, it's a 13-hour drive. And now I've lived in Ohio for over 10 years now, so I've made this trip over 20 times, and I have had every bit of type of weather on this drive as you can imagine. I've driven it in snow in the Christmas. I've driven it in rain and thunder and crazy winds and rain where I can't see. I've driven past storms and tried to outrun tornadoes. This drive has always been a really fun drive. The best way to do it is to do it on Christmas Day coming back, and then it's like a 9-hour drive.
No
flat.
traffic.
No traffic at all, and no cops. Yeah.
There you go.
But I would say the worst, out of all those, the worst was when I tried to fly to Park City the second time. And it was when Dallas got hit with this huge ice storm and we were connecting through Dallas. So all of our group had to like reroute flights somewhere different. Mine got rerouted from DC to Phoenix to Salt Lake. And my flight from DC was delayed. So I got into Phoenix super late, missed my flight to Salt Lake, had to stay overnight in Phoenix. They didn't tell us for like several hours, and then they gave us all the same hotel. And so I show up to this hotel at like 2 a.m. and the line is like out the door into the parking lot. And then they say,
Jeez.
we don't have any rooms, and I was like right at the front of the line, and I was like, you better kick somebody out. I don't know what's going on.
So what'd you do?
They lied to us and they did have rooms. They like called Delta or something and they like figured it out. Yeah. So they were just liars. But that was like probably the most frustrating ride to like, keep it together. Don't end up in a jail cell.
Yeah.
Yeah.
No, those moments really test your patience. I had one over the weekend, and this is definitely not the worst travel horror story I had. The worst would probably take a whole 30-minute pod to explain.
Mm-hmm.
But I was supposed to go to Tampa last weekend. My buddy just moved down there, so was going to visit him. And I think I've talked about this on the pod. For less than 2-hour flights, I'm still committed to these cheap airlines, Spirit and Frontier. I'm like, I'll save $200 and it's an hour of discomfort, and I go with it. I think I might be getting out of that phase because I had some bad Frontier experience. But our flight was at 4:30. I had some work I still needed to knock out up until the flight. So I go to the airport during my lunch break and then like did my work at the airport lounge. So got to the airport at noon. And usually like it's almost never not delayed for a Frontier flight. So it was not being delayed. It's still 4:30. And I was like, oh, this is like, I left the lounge, like was walking over. I was like, no way. Like we're not going to have a delay. This is amazing. And I get there and like people are boarding and I'm like, oh my God, perfect. Like everything's going great. People were boarding for the flight before, so they hadn't even brought our plane yet. And so I was like, okay, typical Frontier. I'm not mad or anything. Like an hour delay I'm expecting that. So they push it to 5:30 and it gets pushed to 6, pushed to 6:30. We finally board at 7. So 2.5 hours later, we all board. We're like, okay, finally, let's go. And we sit. The pilot comes over the intercom. Is like, sorry for the delay. There was an issue with the AC. So once we get up in the air, the AC will be cranking, but it's going to be a little bit hot until we leave. So we're kind of melting at this point. An hour goes by. We're still sitting there. No news. And then the pilot comes up and is like, because of the delay, our flight attendants have run out of their time due to the FAA regulation, and we need new flight attendants. So now we need to get new flight attendants and are going to wait until we get new flight attendants. So then another 30 minutes goes by, and then someone comes over and is like, I'm sorry to bring the bad news. All this time, we're melting. There's no AC. Like, this is an hour and a half in a plane. Everyone's PO'd. Like it's getting bad. And then this guy comes over and is like, we're gonna have to deplane. And then we're gonna try to find the flight attendants. And then like everyone starts verbally assaulting this guy. I was like, I've gone through really bad travel horror stories. So like I was like, I'm at home. I can go to my house. Like big picture was okay. But everyone was really, really mad. We deplane, and then as soon as we deplane, they tell us it's canceled. So was at the airport from 12 to 9 p.m. without ever leaving, which was great.
I do. I feel for some of these employees of the airlines that just have to deliver bad news that is so far out of their
It's
control.
tough.
And yeah, that's rough. I would have been mad. I've been in that situation where you sit on the runway for like 4 hours and you're like, dude, just
Brutal.
let us off, man. Like we know
Yeah.
this is not going anywhere.
Yeah.
Come on. You know?
Exactly. Well, we have an awesome episode today talking about what to do with an old 401k, whether it makes sense or what to do with an old 401k. I'll leave it at that, but let's run the intro.
Hello, and welcome to Map Your Money, a finance-focused podcast. We exist to simplify the lives of our clients and listeners and to help individuals create the roadmap for their financial future. Calls are pre-screened and the content was pre-recorded. Please note that the content presented is for educational purposes only. We encourage you to consult a financial advisor or conduct your own due diligence before making any investment decisions. All information provided is believed to be reliable but is not guaranteed for accuracy or completeness. This presentation does not constitute investment, legal, or tax advice, nor an offer to buy or sell any security or insurance product. It also does not endorse any third party or their views. All examples are hypothetical and for illustrative purposes only. Our commodity trading strategies include assets like gold, which historically may serve as a hedge against downturns in risk assets such as the S&P 500. During significant market events, gold often demonstrates a low or negative correlation, providing potential diversification benefits. 401ks allow for penalty-free withdrawals starting at age 55 under the Rule of 55, which applies if you leave your job during or after the calendar year you turn 55. This is a feature specific to 401ks. While IRAs do not have this exact provision, they offer other options like 72T distributions for early withdrawals under specific conditions. Periodic payments, which you may need to take from your IRA for 5 years or until you hit 59.5, whichever comes later, are subject to specific IRS rules. It's important to understand that these withdrawals may have tax implications and could incur penalties if not properly structured under the IRS guidelines for substantially equal periodic payments. When your employer matches your 401k or IRA contributions, it's like receiving a 100% return on your investment up to the match limit. This is a valuable opportunity to maximize your retirement savings. Moving a 401k into an IRA can offer certain advantages, depending on their specific financial situation and goals. Always consult with a qualified financial advisor before making any investment decisions. All content presented is for educational purposes only. All examples are hypothetical, for illustrative purposes only, and are merely arithmetic calculations. They are based on assumptions and estimates that may not be accurate or applicable to your individual situation.
All right. So like I mentioned, we're talking about what to do with an old 401k. So if you left a job and you have an old 401k, if you're retired and have an old 401k, you left a job 5 years ago and you still haven't touched your old 401k, we're talking to you today too. So first, kind of wanted to start with what are your options with the old 401k. I'm going to talk about every single option, and then we'll kind of dive into a bigger picture. But 4 total options that I can think of. 1, keep it with your old employer and custodian. You worked for Delta Airlines, and their plan is at Fidelity. You keep that plan at Fidelity, even though now you're working at Southwest and their plan is elsewhere at Schwab or whatever. So you keep it with your old employer at the old custodian. Sometimes they force you out, but that's an option. Second option is you can move your old 401k into your current company's 401k if you're still working. Obviously, that's not an option if you'd retired. The third option would be rolling that over into an individual retirement account, or more commonly known as the IRA. And then the fourth option is just take that money out. You are going to pay taxes on it. And if you're under 59 and a half, you are going to get penalized by 10%. I think objectively, I can say that almost every single financial advisor in the world would tell you that is the worst option for you. Maybe there's a situation where it makes sense to take out a portion or whatever, but you're going to get killed with the taxes and the penalty, and it doesn't really make sense. But
Wouldn't it make more
ultimately,
sense in that scenario, Arish, to just take a loan?
yeah. I don't want to go into the deep rabbit hole of when maybe it could make sense or whatnot. But yeah,
I'm just thinking of
that would be the
when that
last
would
thing
never
you'd
be an
want to do.
option.
Yeah. No,
Okay.
It's something you want to avoid, like for sure. But ultimately, out of all four of those options, it ultimately comes down to, do you want to keep it in a 401k, whether it's your old companies or your new companies, or do you want to move it into an IRA? So today is really just jumping into that. What are the differences? What are the pros, the cons? And kind of just jumping into that and what we usually recommend and why we think that makes sense. So the first part of it, I would say, and I would also say this is probably the biggest component of it, is the investment option aspect. I'd say this is the biggest difference. I'd say this is the most important difference. When you think of a 401k versus an IRA, so if 401k, you are a participant of an employer plan. So even though that's your asset in a way, it's also not fully your asset in a way. You are subject to whatever your employer decides. So if they want to have blackout periods, or if they want to change the investment options, or whatever it might be, you are subject to all of that. You don't have as much control. With an IRA, the I stands for individual retirement account. Individual meaning it's yours. You have full control. You have a lot more options there. And when you think about it, why that makes sense is 401ks, they could have the ability to invest in. Chris is probably going to listen to this. Chris is our 401k guy and be like, yeah, Arish, you're all wrong. But ultimately, 401k guys like Chris will go to employers and say, okay, what do we want to offer in this plan for your employees? And your employers are ultimately deciding, okay, we want the lowest IQ person or every single person at our firm or at our company to be able to go in and choose investment options that they feel confident in meeting their retirement goals. If every 401k had every investment option available to you in the universe, think about the lowest IQ person at your job. I know you're probably thinking of someone, listener. I'm not talking to you, Jeff, but if someone's coming to mind, whatever. Yeah, I definitely not. But so if you think about that, and they had every investment option in the world, they'd probably be lost on what to do. People would make a lot of bad decisions. Maybe someone goes all into GameStop, got super rich. Maybe someone goes all into something that didn't do too hot. Enron of today or whatever.
Or GameStop after.
Or GameStop after. Exactly. And then they'd be mad at their employer, and that would cause issues. So that's why a 401k typically has a lot of limited options. A lot of target date funds are really common. And I bet 90% of the listeners here are invested in a target date fund. We can go into that. But Jeff, I wanted to turn it over to you to really facilitate this part of the conversation with kind of the differences in the investments between an IRA versus a 401k.
Yeah, I think you really hit on it. By the way, we're always happy to go through our clients' 401k investment options and create a custom allocation for them. I think you really hit on it as far as the availability of options in IRAs. I mean, especially, where we work, we're an independent financial intermediary wealth management firm. So we have really unlimited options. Really, we have options across the whole universe to decide what funds that we want. And that gives me a lot of flexibility in a lot of different ways. If you think about, mid or small cap, you can have a mid-cap manager, you can have a mid-cap index, you can have a manager that leans growth or leans value or is purely in one camp or the other, or you can have a manager that has a certain style or likes a certain characteristic of a company. And there's just all kinds of ways that you can slice and dice a way to invest in mid-caps where you can find different strategies that perform differently, even though they're kind of within the same ecosystem. And in 401k, probably what you're going to have is either one, just a mid-cap index fund. Two, maybe some kind of small and mid-cap combination. Maybe you would see these called SMID, S-M-I-D, on the 401k, and sometimes that can be the only option. Or usually you're given an index and one active manager. Maybe that manager is on the value side. Maybe they're on the growth side. Maybe they're not a good manager at all, and you don't want to use them from the index. But if you're somebody that believes in active management and the value that it can provide, like I do, the narrowness of the options of the 401k really don't give you that flexibility to choose what manager you want, and sometimes don't even give you the ability to choose a manager at all. I think that's one of the biggest differences. And this is not just, within mutual funds, this is in ETFs too. I mean, we use an ETF that we like in small cap world, which we think is really important because in small caps, when you buy the index, some small companies are failing, right? And they have done really poorly. Some small companies are at the very beginning of their growth cycle, so they don't have any revenue now, but they may in the future, but that's about as risky of a bet as you can make. And so what ends up happening is 40% of that index, Russell 2000, is unprofitable. Well, we think it's important to own profitable companies that we think we can earn a return on. Returns come from earnings growth mostly, and that's certainly true over the long term. And so we use an ETF that screens for profitability and quality and low leverage within the small cap universe, so we kind of separate out some of those unprofitable companies we don't want. That's pretty unique. And there's not a lot of other ETFs that do it that way, in a way that has the tracking, the track record of this ETF that we use, but you can't find that in a 401k, right? And so from the investment option standpoint, I think it's really important to consider all those. And I didn't even speak about index-heavy 401k options. I've seen 401ks with 5 options, and one of those is almost always going to be the S&P 500. And we talk all the time about how the S&P 500 is no longer a diversified index from a standpoint of a single stock diversification. It's more diversified there, but still a lot of concentration in tech. From a factor standpoint, it's pretty much a growth index now. And from a sector standpoint, it's pretty much all tech companies, even though some of them are classified as consumer discretionary, like Tesla and Amazon, or as communication services like Google and Meta. So you add all those up, and it's 50% of the S&P is in those kind of tech adjacent type companies. So we get the option to spread that large cap allocation out, but in 401ks, a lot of times people don't.
Yeah, and then I wanted to take it even one step further. I mean, all those points you make, obviously extremely, extremely valid, and probably the biggest or most important reason or difference on the investment side. But additionally, in the 401k, I feel like it's also really hard to also get good diversification because you don't have the ability to invest in other asset classes, such as commodities, for example, or we talk about crypto every third or fourth episode, and it's a very small allocation we have, but it's a way we diversify. And so there's other asset classes that you can't get exposure to as well, beyond just probably being all in the S&P 500. And even if you're in a target date fund, hate to break it to you, a lot of that's going to be in the S&P 500. And again, that's not very diversified right now.
Yeah, I think that's a great point. I have written down here commodities. This year, a huge story in markets has been the price performance of gold, which, as I look right now, is up 27% as of the morning of June 20th, 27% year to date. And, that's something that in a lot of 401k plans, they don't really have a lot of commodity options. If you have any kind of like specialty investment option in 401k, 99% of the time, it's some kind of Vanguard real estate index. And what you're going to own with that is you're going to own, warehouses and retail shops and, cell towers and radio towers and stuff like that, which is fine, but it's just not, it's not in itself like all that great, right? Or all that differentiated, versus if you can own a collection of commodities or commodity trading strategies that has zero correlation to the S&P, they own a little bit of gold in that, which correlations between gold and risk assets drop to -1 whenever something really bad happens. So think about it this way, listener, when the S&P 500 and equities and cryptos and all that are falling, gold is rising. That's like they jump to inverse correlations. And so that's really powerful for a portfolio. It's one of those things that you can say, look, I don't know what's going to happen, but I know if something happens, gold will do well and offset that loss. And that's a really easy way to build in diversification to a portfolio. But also think about like defensive sectors like infrastructure. There's a lot of talk about pipelines and liquid natural gas export terminals. We talked about the cell tower. You'll see some of those in these infrastructure related funds as very specialty, but it's also very defensive and income driven, which some people really like for the lower risk profile. So, there really is all kinds of different angles that you can go with this. But I think at the end of the day, it's, selection of these investments and knowing when to invest in them is important too. And so it's not just the availability of the investments and the flexibility, but it's also having somebody to help you choose the right investments and build a complete allocation at the right time, given the environment. And that's another thing that I think we add value for 401ks that are rolled over into IRAs versus something like, say, a target date fund, which really is not going to be as customized and maybe not as optimal for your client situation.
Yeah, and we could probably do a whole episode on talking about target date funds and what we think they do well and what they don't. But we'll spare you, listener, on this time. I want to kind of go more into financial planning and the other differences between the 401k and IRA. But Jeff, we need to come up with a name for our listeners. Every good podcast I know has some name for their listeners. Like I'm a big Part of My Take fan. It's a Barstool podcast. They call their listeners AWLs, award-winning listeners, and we need to come with something.
Lady Gaga has Monsters, right? And
yeah, exactly.
Bieber has Believers.
Yeah, there you go. We need a workshop. Yeah, Mappers.
The Mappers.
Okay.
Yeah.
Okay, that kind of works. I like it. All right, Mapper. Let's just go to the next topic.
Those mapping their money.
There you go. I like it. So I want to kind of talk about more differences in terms of the provisions around a 401k versus an IRA beyond like the investments. Obviously is like I mentioned, I think probably the most important piece there, but there are some other pieces that I think are worth noting. So one thing that you can do in a 401k that you can't do in an IRA is take a loan from your 401k. This is not something that you're able to do in an individual retirement account. But in a 401k, depends on your plan, but the majority will let you take a loan from your 401k up to 50% of your balance, but it maxes out at $50,000. So you can max take out $50,000 from your 401k. If you have an old 401k, you're retiring, for example, or maybe you're going to a job that doesn't have a 401k, or you're going to another job and you say, hey, maybe I need to take a 401k loan in the next few years. Maybe your financial situation's a little bit tighter, and that's maybe one of the only options you have for capital. If you move that into an IRA, you don't really have that same option to take that money out with the loan. And there are some benefits with 401k loans. That interest gets paid back to you, and different things like that. But ultimately, at the end of the day, if you're able to not borrow from your retirement assets and not stop your earning potential for your retirement, it's going to be recommended to not do so. But it is something to recognize. If you say, hey, I might need $50,000 from my 401k, I was counting on that as an asset I want to pull from, then that might be a reason to keep $100,000 in a 401k and say, okay, I can take out $50,000 and I'll roll over the remainder to kind of have that loan ability. But any thoughts or comments there, Jeff?
I mean, where would you say that stacks up? Like, as far as liquidity and accessing liquidity is so important as far as the priority in which you sell your assets, right? And we talked about what is the last thing that you would do. You would take an early distribution from a 401k or IRA. So is a loan from a 401k, is this like the second to last option? Is this, probably better than like just putting it on a credit card that has a 20% APR versus a 401k loan that could be more reasonable?
Exactly.
But it's not exactly great compared to like withdrawing from a non-qualified account, for instance.
Oh,
right?
yeah. All of that is way above. I think this stands towards that bottom of that. If you're putting it on a scale, and withdrawing from the qualified account and taking the 10% penalty is probably the bottom of that. 401k loan and a HELOC are around that same level. Credit cards is under that and probably above the IRA withdrawal.
Credit cards, like
it's around the same. Yeah, it's around that same place you would think of, okay, do I want to take equity out of my house? Then it's probably worth weighing, okay, maybe does it make more sense to do a 401k loan? I'd say it's kind of around that level. Another thing that you have, another advantage, I guess you could say, of the 401k is you have what's called a Rule 55 rule. So this allows you to take money out of your 401k before you're 59 and a half. So 401ks and IRAs have this same rule that to avoid the penalty, and this is kind of everyone, one thing is like once you're 59 and a half or older in your 401k or your IRA, you're able to take that money out without penalty, without that 10% penalty. You're still taxed on it if it was pre-tax money, but you're able to take it out without that penalty. 401ks have the ability to actually take that money out earlier. You can take it out at age 55. This is unique for a 401k. You can't do this in an IRA. So if you're looking at an earlier retirement at 55, needing to withdraw these 401k assets, maybe it makes sense to keep it in a 401k. I would argue, though, a lot of people don't know this about the IRA, is you can still take money out of the IRA without penalty, but it's not the age 55 rule. It's what's called 72T. And so this is substantially equal periodic payments, which you need to take from your IRA for 5 years or until you hit 59 and a half, whichever comes later. So if you start, let's say you want to retire at 52, you move your 401k into an IRA and you need to take that money, you can take what they classify as substantially equal periodic payments at that point for 5 years or 59 and a half, whichever is later. So if you're doing that at 52, 5 years would get you to 57. So you have to do that until 59 and a half. So you can't just take out 15,000 for 5 years and then stop if you wanted to. You have to take that out until you hit that age 60, basically, and then you can do whatever you want at that point. I would actually argue that you could say this is, I don't want to go into that rabbit hole either, but this is something that's advantageous about the IRA, is that you can take this money out even before 55. Again, when we get into planning and things like that, it's probably not the first place we want to take money. And hopefully you've prepared yourself for your retirement and you're doing an early retirement. We would hope you have non-qualified assets, and that would be the best place to kind of go there. And then we can do super fancy things like a Roth conversion and all this fun tax planning stuff, which we'll save for another episode.
I think that's really interesting. I mean, you talked about how the last thing you would want to do for liquidity is take it from your IRA or 401k before 59 and a half. And then you outline two different avenues that which you can take it out before the penalty. But what I'm hearing is, was it 72T, that option where you have to take the equal payments periodically? It seems a lot less flexible, that you're really committing to something for a long time and you don't really have the option to back out. Is there any kind of risk for the client that's thinking about that, with if they mess up that payment or they forget it, there's some kind of penalty associated?
Yeah, I mean, the penalty is just the 10%. Like, it's like you didn't. It just becomes the early withdrawal penalty.
So there's a pretty big, issue there if you mess that up.
Yeah, and I would say that
the 55. Yeah, the other option is a little more flexible, you would say?
Sure, yeah, definitely.
So we're talking about the flexibility now.
Yeah.
The rule of 55, right? You really can take distributions. They don't have to be equal. They don't have to be periodic, right? But you keep that in your 401k after you leave service. But the 72Ts, like, you rolled it over and you can access it before 59 and a half. But in order to do that, you have to like jump through a bunch of hoops and keep it consistent, or you're liable for that penalty.
And so the one point I was going to make there is, like, yes, you can withdraw early from the 401k with the Rule 55. You can withdraw early from the IRA with 72T. Ultimately, if you're wanting to withdraw from these earlier, you need to have planned very, very carefully to make sure that these assets are still going to be able to last you your whole retirement. And again, like I mentioned, we would hope clients have done a lot of planning around this and either know that they can do that, or know that, okay, this isn't the best place for me to take out my money right now. Let me use money I put into a brokerage account. When we say non-qualified, that's like advisor speak, but a brokerage account or a savings account. And I'll go down the Roth conversion rabbit hole if I keep going, but a ton of tax planning opportunities there in doing that. So these are options that every 401k and IRA has, and these are exceptions to the rule, But I think it's important to recognize, and when we're talking about kind of differences of the 401k and IRA, I think it's important for the mappers to know.
That's right. So tell the map. That's one thing that you've left out for the mappers. We have all kinds of advanced age mappers. We have some that are close to retirement. We have some that are not even thinking about retirement, but have already started saving. So for those mappers, what do you think is like the minimum 401k contribution that you would recommend to them? How should they be thinking about their contribution amounts for somebody that's not quite in the phase of thinking about withdrawing, but is still in the phase of accumulating and contributing?
I think the absolute minimum you have to contribute into your 401k is the max of your match. So if your employer is matching 4%, at least get that 4% and contribute whatever you need to get that 4%. I think that's something that's kind of misconstrued sometimes is, oh, I get a 4% match, I'm going to contribute 4%. I'm getting my full 4% match. Sometimes it's set up to where it's 100% of your first 3% gets matched, and then 50% of your next 2% gets matched. So to get your full 4% match, you need to contribute 5% in that scenario to get the 4% match. So make sure you're paying attention to that. And that's free money. You get a 100% return on that investment. And whatever you're choosing in your 401k or IRA, it's pretty hard to beat an immediate 100% return.
It is. That is tough to do. Being given money is the easiest way to get rich.
For sure. So those are the main differences. This part is going to get a little in the weeds. So Jeff, pull me back as soon as I kind of do, make sure I stay on topic here.
All right, we'll do.
This is the other scenario, and probably the only other scenario where I'd recommend a client or listener or mapper, whoever it is, to keep their money from an old 401k and move it into a new 401k. If you haven't gotten the gist, our typical recommendation is to move your money into an IRA. You have better investment options. You have more control of the money. And ultimately, sure, you might not be able to take a loan from it. Sure, you might not be able to do the age 55. But ultimately, we think those shouldn't matter in making your decision. This is the one scenario where I'd say sometimes it makes sense to actually keep your money in a 401k. And it maybe will apply to one mapper. It's a very, very unique situation. But
how many times have you seen
have?
It?
So I specifically plan for it sometimes. So a couple. It's like a handful.
Okay.
But so if you have an old 401k, let's say you just moved jobs, and you don't have any traditional IRA, you have no money in a traditional IRA, and so at your new job, you're going to max out your benefit from your 401k. You are going to max contribute. So if you're under 50, that's $23,500. If you're over 50, that's $31,000. So that's a no-brainer. You're able to do that. You're going to do that. Plus, you want to contribute more, and you want to contribute more via a Roth contribution. And so this is really just applicable for young people that are making a lot of money. And so people who have a long time before retirement, but are making substantial income. And so they're over the income limit to contribute into a Roth IRA. To contribute it directly into a Roth IRA, don't quote me on these, but I want to say it's like $160,000 for an individual, or $240,000 for a couple, as your income. If you're above that amount, you can't directly contribute into a Roth IRA. Stay with me. I told you we're getting in the weeds. This is different than a Roth 401k. You can still contribute into a Roth. If you're making $500,000, you can say I'm doing my whole contribution, my $23,500, into my Roth 401k, and that doesn't matter about your income. So, we still there? Have I lost you, Jeff? Does that make sense?
I'm here. I got you.
All right, perfect. So you're over that income limit. You're already going to be maxing your new 401k, and you don't have an IRA balance. So you don't have another 401k that you've moved into an IRA. There's no traditional IRA balance. In that scenario, sometimes it makes sense to take your old 401k and move it into your new company's 401k so you're able to do backdoor Roth contributions. And again, the only reason this makes sense is if you're younger, because it's $7,000 a year. So it's not a huge number that, like, if you're 55 and retiring at 60, probably doesn't make sense with 5 years of doing backdoor Roth contributions. It's not going to really move the needle substantially. But if you're 30 or 35 or whatever it might be, and you're able to do backdoor Roths of 7,000, and they'll increase that number every year, into your Roth IRA on top of what you're doing in your 401k, it could be a worthwhile number. And so again, it's not very applicable for a lot of people, but a backdoor Roth is when you contribute into a traditional IRA and then roll that over into a Roth IRA. And it's a way of going around that income limit. Again, even all this 401k side of stuff aside, if you are over the income limit, but you already have a traditional IRA balance, you can't do this, because if you contribute into a traditional IRA and roll that into a Roth IRA, then you will be taxed pro rata on that money. So if you put $7,000 into a traditional IRA and you have $100,000 balance, and you try to move $7,000 over, $7,000 out of that $100,000 will be tax free. So whatever percentage that is, the rest you'll be taxed on as ordinary income in that year, you're not getting the benefit of it, if that makes sense.
You have to move over the full IRA into the new Roth? That's what you're saying?
No, you would move $7,000, but 7% of it only 7% of it would be tax free. The other 93%, the 6,300, you'd be taxed on as income as you're basically taking that money out. If that makes sense.
If you don't have the IRA and the only thing you put into that IRA is kind of what you intend to backdoor Roth convert.
Exactly.
100% of it's going in. So 100% pro rata applied is you don't have to pay that tax. Oh, okay.
Exactly. Yeah.
Wow.
So I say we're going in the weeds. Probably lost to some mappers there. But I think it's fun to in host. There you go. Well, I'm lost half the times you go into the investment stuff. So, but no, I think it's good to kind of recognize. I think maybe that'll hit home for one or two mappers, but ultimately, like, want to come to the big picture on differences in the 401k and IRA. Sure, we can go into the weeds and talk about a million different scenarios. I'd say for the vast majority of people, it makes sense to move a 401k into an IRA. And ultimately, I led off with it. The biggest difference is the investment options. And ultimately, that's what we think matters the most in making this decision. And we do think it is a substantial difference in what you can get in an IRA versus a 401k.
Yeah, I think so too. And we didn't talk about this much, but the professional management, the rebalancing, the asset allocation decisions, how much do I want in stocks versus bonds, and how should that change over time as I approach retirement? And then, something that some people don't recognize is funds in your 401k that may be performing well, maybe the lead PM who's responsible for that performance leaves. And now it's a new guy that can't replicate that performance. And so your future performance isn't going to be as good. These are things that people like me monitor and make adjustments for all the time for our clients. And it's something that as an average 401k participant, some people probably don't think about.
For sure. Well, I know we ran a little bit long, but I think that was a great discussion, and certainly something that applies to a ton of people, whether you have an old 401k that you still haven't touched, or you're moving jobs or whatever it might be. Hopefully this is able to provide some guidance there. And mappers, we hope with the travel coming up this summer that you may be doing, you have no horror stories like Jeff and I have endured.
Definitely hope that the mappers avoid that.
Oh yeah, I love mappers. I'm gonna start calling everyone a mapper.
No, I like it too. Whoever came up with that was really on it.
Probably a really smart guy. Yeah.
Probably lowest IQ.
Yeah. All right. I'll see you, Jeff. Appreciate you.
Thank you for listening to our podcast. Remember, the views expressed are not necessarily those of Beam Wealth Advisors. All content is for educational purposes only and should not be construed as an endorsement of any third party or their views. or as a solicitation or offer to sell securities or provide investment, tax, legal, or consulting services. We believe the information presented to be reliable, but it is not guaranteed for accuracy or completeness. Investing involves risk, including the potential loss of principal. Hypothetical returns do not reflect actual trading and may not be indicative of the performance of any specific investment. Always consult with a qualified financial advisor before making any investment decisions. Past performance is not a guarantee of future results. Additional information, including management fees and expenses, is provided on our Form ADV Part 2, available upon request or at the SEC's Investment Advisor Public Disclosure website, advisorinfo.sec.gov. Our commodity trading strategies include assets like gold, which historically may serve as a hedge against downturns in risk assets such as the S&P 500. During significant market events, gold often demonstrates a low or negative correlation, providing potential diversification benefits. 401ks allow for penalty-free withdrawals starting at age 55 under the Rule of 55, which applies if you leave your job during or after the calendar year you turn 55. This is a feature specific to 401ks. While IRAs do not have this exact provision, they offer other options like 72T distributions for early withdrawals under specific conditions. Periodic payments, which you may need to take from your IRA for 5 years or until you hit 59.5, whichever comes later, are subject to specific IRS rules. It's important to understand that these withdrawals may have tax implications and could incur penalties if not properly structured under the IRS guidelines for substantially equal periodic payments. When your employer matches your 401k or IRA contributions, it's like receiving a 100% return on your investment up to the match limit. This is a valuable opportunity to maximize your retirement savings. Moving a 401k into an IRA can offer certain advantages, depending on their specific financial situation and goals. Always consult with a qualified financial advisor before making any investment decisions. All content presented is for educational purposes only. All examples are hypothetical, for illustrative purposes only, and are merely arithmetic calculations. They are based on assumptions and estimates that may not be accurate or applicable to your individual situation.